Hello, everyone. Thanks for coming out. Before we dive into our presentation, let's warm up with a little tax brain teaser about Bill. Sounds like fun, right? So, after working hard for his adult life, Bill, 65, has finally retired and he's going to more concerts than ever before. Bill has $48,988 in taxable income, which includes $37,500 of Social Security benefits this year. As you can see, Bill's 48,988 of taxable income puts him in the 22% tax bracket because it's more than 47,151 and less than 100,525. Toward the end of the year, Bill decides to take an extra $1,000 out of his IRA for a trip to see Paul McCartney play in Austin. How much is he taxed on that extra $1,000?
The logical answer is that for every dollar of IRA money he pulls out, he pays 22 cents in federal income taxes. Therefore, if he took out $1,000, he should owe $220 in federal income tax, 22% tax. Simple enough, right?
He owes $407 in tax, a 40.7% federal tax rate on that income. Thanks to the madness that is our tax code and the unique formula that determines how your Social Security benefits are taxed, the real answer is that Bill owes $407 on that extra income.
So welcome to our presentation, How Tax Planning Changes Through the 4 Stages of Retirement. Speaking of Bill, my name is also Bill. I'm Bill Liberty, the CEO of Wealth Effects. I'd like to introduce Bernie Katz, who most of you already know. In addition to being an investment advisor, Bernie was also previously a CPA. I thank you for coming out to learn more about taxes in retirement. And I want to assure you of one thing about this presentation. I believe you'll be better informed about the challenges of retirement tax planning after listening to this talk. Now, you may be wondering, why are financial professionals giving a presentation about retirement tax planning? We do this presentation because we've seen many people make mistakes and pay more in taxes in retirement than is necessary. When that happens, it makes our job harder because people have less income in retirement and we have to find ways to make their portfolios last. Taxes can seem complex and jargon-filled, even though the underlying concepts are fairly straightforward. This webinar is only part 1 of a series. Each webinar builds on the previous one, as you'll see. Now, you may have questions as we go along. To respect people's time and keep the webinar short, please place any questions in the chat box. We will be collecting questions and we'll get back to you personally with an answer, and we'll provide everyone with a synopsis of all the questions and answers. But now, there's one other important point we need to make.
Everyone's tax situation is different. You should always consult a qualified professional tax advisor to discuss your specific tax situation, especially about these topics. Traditional IRAs, which are tax deferred. You must pay taxes on distributions or conversions at ordinary federal and state rates. Roth IRAs, which are non-deductible. Money grows tax-free and earnings may be withdrawn tax-free in accordance with IRS rules. State taxes. This presentation references federal taxes. You may still face state taxes. Check with your tax professional. Although I'm a former CPA, I'm currently a full-time wealth manager, and I do not provide tax advice. What I do is help people understand how the tax code and other rules could impact their financial planning and investments, and then we develop a plan to take into account many of the odd things people encounter, especially around taxes in retirement. Our goal here is to help you understand that the retirement distribution game, which is spending assets in retirement, is much different than the accumulation game when you're saving for retirement. Chances are you have been in the accumulation phase of your life for several decades, and you've been working hard and trying to save money, and hopefully your accounts have grown. But now, as you enter or prepare for retirement, You're in an entirely different phase, the distribution phase. And the distribution phase has new strange rules that can catch people off guard. And along with those new rules, there are often many changes in your own personal life that can have a big impact on your taxes too. For instance, your children are grown, and that means no more child tax credits. Your house may be fully paid off, and that means no more mortgage interest deduction. If you've already retired, you may no longer be receiving tax-free employer-paid medical insurance. If you stop working, you may no longer have the ability to stash income in a 401k or similar plan to manage your annual tax bill. At some point, you'll start taking Social Security, and sooner or later, when you reach 73, you'll have to start taking required distributions from your retirement accounts. The list of changes goes on. Many aspects of retirement will affect your tax bill in ways totally different from your working years. Understanding what these are and how they can impact you is absolutely crucial.
Now, at this point, you may be thinking, okay, so what's the first thing I need to understand about retirement and taxes? Well, here it is, our first key.
You have to know what your after-tax retirement savings picture looks like before you actually retire. Because a $500,000 401k or IRA balance isn't really $500,000. The government has a claim on part of that money because the taxes were deferred. They'll get their share when you're forced to start your required minimum distributions. The Secure Act 2.0 has pushed back RMDs to 73 if you were born between 1951 and 1959. If you were born after that, you won't have to start taking RMDs until you turn 75. Obviously, the higher your tax rate in retirement, the less your account is actually worth. Here's an example. The chart shows you the cumulative after-tax value of a $500,000 IRA earning 6% per year at various tax rates. And as you can see, the lower your tax rate, the more you keep. Simple in theory, difficult in practice. And by the way, of course, this presentation applies to both pre-retiree and retirees. So don't worry if you've already started your retirement. Tax planning is important throughout your retirement.
Now, you may be thinking, okay, my accounts may not be worth as much as I thought, but I'll have a steady flow of benefits from Social Security to supplement my income, and I'll have Medicare to pay my healthcare costs. But one thing you need to understand when creating a retirement tax strategy is
Social Security and Medicare have their own tax traps that you need to plan for as well. Just as a reminder, this is part one of a series. We plan on touching on more Social Security and tax topics in our future webinars. If you have a specific topic that is of interest to you, share in the chat box for us. Let's go back to Bill from our tax brain tease. We want to understand why he paid such a high tax rate on the extra money he took from an IRA to go on a concert road trip. Remember, Bill has $40,000 of IRA income, part of his adjusted gross income of $65,538, and he has $37,500 of Social Security benefits. That puts him squarely in the 22% bracket, and he takes the standard deduction. Yet, when he took that extra $1,000 IRA distribution, he got hit with nearly 41% marginal tax rate, which was $407 on that $1,000. Let's break down how this actually happens. First, let's remember the only difference between our two scenarios here is that Bill has taken an additional $1,000 from an IRA. You see that in after concert trip column, he has $41,000 in IRA income. So we see here that by adding that additional $1,000 of actual income, it increased both his AGI and his taxable income by $1,850. That means for every dollar of income he actually received, he's being taxed on $1.85. Huh? How? Here's the deal. Depending upon how much other income you have, the amount of your Social Security benefits that are taxable varies. For instance, if your other income is low enough, all of your Social Security benefits will be income tax free at the federal level. On the other hand, if your income is high enough, up to 85% of your Social Security benefits can be taxable at whatever your personal rate is. Bill finds himself in the latter scenario. At his current income after the concert trip, for every dollar that he takes out of his IRA, he not only adds $1 of IRA money to his taxable income, but he must also add an additional 85 cents of taxable Social Security benefits. And if you add that up, that's $1.85 taxable at his 22% rate for every $1 of additional IRA income he actually receives. If you do the math on that, it comes out to 40.7% real tax rate on the additional $1,000 income. That's the so-called Social Security tax torpedo. It can impact single filers and married couples with even fairly modest income during any stage of retirement. It's one reason planning taxes in retirement is important.
Okay, we're toward the end and you're probably thinking, goodness, how in the world will we ever manage this? It's a good question. Let's bring it all together.
Because your tax exposure will change throughout retirement, you need a strategy that anticipates how and when you tap assets to cover your personal expenses, understands the range of taxes you will face at various stages, manages your actions so you can pay the lowest tax rate possible. By attending this webinar, you're indicating that you're preparing to leave the accumulation phase, which is saving for retirement, and moving to the distribution phase when you start spending retirement assets. We've seen that the distribution phase is more complicated than working and collecting a paycheck. Managing your tax rate through the 4 stages of retirement is part of the challenge of retirement planning. We've seen the cost of mistakes. Naturally, we want to be efficient with our savings, and there are strategies to reduce your tax burden. But as with many things in life, this takes education and planning and advice. It's a lot to think about. Our tax code is complex and the rules keep changing. But what doesn't change is that you need a plan. I'd like to help you get started with creating a retirement tax planning strategy. We can schedule a one-on-one meeting where we can talk about your retirement and tax savings needs and the role taxes play. During that meeting, we identify where you and your family stand in regard to preparing for retirement, review your timeline, and identify key retirement planning and tax issues you need to anticipate. Coming out of that meeting, we can act as your resource and help you find the right people to assist you in specific tax advice. If needed, naturally, we can help you with the key financial planning and investment advice that relates to your situation too. Regardless, when you leave our meeting, you'll be better informed about your retirement planning needs and what to consider doing next. We want you to be prepared and organized for this aspect of your life so that you and your family can have peace of mind knowing that you've got a plan for making the most of your retirement accounts. If you are interested, please reach out to me. My email and phone number will be on the last slide. This webinar is the first installment in how tax planning changes through 4 stages of retirement. Our next topic will cover Medicare and taxes. We truly appreciate your time today. Please don't hesitate to reach out to me through phone or email if you need more information. If you left a question in the chat box, you will receive a follow-up email shortly. Lastly, we'd love to hear your feedback on today's session to help us improve our future webinars. So drop that in the chat as well. Thank you again for joining us, and we hope to see you on the next one.